Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at two strong stocks to consider buying before their upcoming earnings releases and possibly holding for the long haul. And they're from two very different industries. The first we're looking at is Micron, and the next up is Lululemon. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these two stocks, as I said, Micron and Lululemon, I want to do just a quick market overview just to give more context for these names heading into their earnings releases next week. So we saw the market cool off a bit on Wednesday. I'm recording this on Thursday afternoon. The market S&P 500 was down about 0.2%, and the Nasdaq was down a similar amount. So cooled off after that nice gain on Tuesday following a slightly hot February CPI report. Kind of the big stories the last couple of days, we saw Dollar Tree tumble as the discount retailers suffering from some lingering inflation. As we all know, they're set to close as many as 1,000 stores. Tesla was another big loser this week. It fell to its lowest level since May 2023 as Wall Street worries that stalling growth for the company itself and the wider EV market. It's now below its 200 week moving average and at very oversold RSI level. So it'll be kind of interesting to see if traders start coming in the next couple weeks and longer term investors, because it might start looking like Tesla's on sale, especially compared to overheated tech stocks. So could be kind of a pivotal stretch for the near-term outlook for Tesla to see if buyers do step in. So it's kind of just worth noting that stock as one of these magnificent seven names that is not doing well, actually, just like Apple and Alphabet. Overall, though, the bulls have pushed stocks higher throughout the year without sending the market into really euphoric highs. Nonetheless, there will be a bigger pullback at some point. It's also worth highlighting, though, that some of Bitcoin's impressive run to new heights might be helping prevent the Nasdaq from reaching these crazy overbought levels. So BlackRock's iShares Bitcoin Trust, which is that IBIT ETF, reached $10 billion faster than any U.S. ETF in history. It needed just 2 months from January 11th to its launch to reach that landmark, which beat Invesco's QQQ, which is that big Nasdaq 100 tracking ETF, of just over a year. So it did it in 2 months, and QQQ did it in over a year. So that just shows how rapid everyone's jumping into these Bitcoin ETFs. So with that said, though, when the market does eventually pull back into some these longer term moving averages like the 50-day or the 21-week, it's worth remembering that you might want to buy into that weakness, because it's always worth just constantly remembering you want to sell into strength and buy into weakness. So if the market's feeling a little top heavy, maybe take some profits off the top, and then as it pulls back to those longer term moving averages, if you're a longer term investor, it's a pretty surefire way to continue make money, especially if you're buying, say, like an S&P 500 ETF or a Nasdaq ETF, something like that. So with that in mind, we're going to start with the first of our two stocks today, and that is Micron, which trades on the ticker MU. The company is set to report its Q2 fiscal 2024 results on March 20th. So Micron shares are up 70% in the last year. In the memory chip powerhouse's outlook is improving rather quickly within the pretty cyclical chip space, and more cyclical is the memory sector. So Wall Street's starting to see MU as a possible AI play as well. Micron is one of the largest makers of memory chips in the world, and its offerings are found in smartphones, PCs, and other devices. It's also growing alongside the expansion of data centers, EVs, and artificial intelligence. So that could be the next kind of big growth area. So the memory industry has been historically even more cyclical compared to the broader semiconductor market and heavily impacted by pricing. Luckily, Micron's slowly becoming a bit more resilient to the wider cyclical spending of, say, smartphones and consumer electronics because of secular growth markets such as data centers and now AI. With that said, it is coming off a pretty big down year, though. That said, the company topped our Q1 estimates, and its stock climbed after that report as the chipmaker predicts that AI will drive record demand for its memory chips. Micron's outlook shows kind of how quickly the memory chip industry can recover. So we're calling for 46% revenue growth in fiscal 2024 to go from 15.5 billion to about 22.7 billion, and then another 45% growth next year in its fiscal 2025. So back-to-back years of 45% revenue growth to get all the way up to $33 billion next year. So going from 15.5 billion in its fiscal 2023 up to 33 billion in its fiscal 2025. So a massive jump. And this comes against what was a big downturn in 2023 when it actually fell by 50%. So that just shows how up and down the herky-jerky nature of Micron has been and could still be going forward. That said, they're hoping that the ongoing use of data centers and AI will maybe kind of shake out some of the massive swings they see. And then on the bottom line, we're calling for the company to shrink its adjusted loss from $4.45 per share to a loss of 32 cents per share this year. That said, its most recent estimate, which is the most accurate estimate we have for Zacks, is coming in at $1.11 per share. So up huge from what we're calling as at the moment, the consensus is a loss of 32 cents per share. So its earnings revisions are trending heavily in the right direction. And then if we look ahead to fiscal 2025, we're calling for massive jump from that expected 32 cents per share loss all the way up to $7.29 per share in positive adjusted earnings. So its earnings revisions are trending heavily in the right direction. And as I said, its most accurate estimates are coming in solidly above, also for 2025 as well, with its most accurate estimate coming in 50% higher than its current already robust outlook for 2025. This helps it land a Zacks ranked number 2 buy at the moment. And now if we take a look at the stock price, this stock's up about 70%, as I said at the top, over the last 12 months. This tops tech's 50%, and it's essentially tracked the wider tech sector over the last decade, up about 290%, though it's been a bit more volatile than the wider tech sector. It's currently trading about 8% below its average Zacks price target and around 10% below its recent highs. And it started to sell off after it broke out to new all-time highs, topping its 2021 and 2022 records. The stock is possibly going to test its 21-day and 50-day moving averages in the near term. After it got a bit overheated, it went above overbought, RSI levels, and it's already now sitting at neutral as the stock's down as I'm recording this on Thursday. Could be, by the time you're listening to this, it could already be testing that 21-day or getting closer to that 50-day. And then if we look longer dated chart, it's trading pretty firmly above its 21 week moving average. And as it comes down, that 21 week moving average could be kind of a buy signal for longer term investors. So maybe you want to wait until Micron reports next week and see how the stock trades. That said, if you're a longer term investor, you don't need to try to time things that precisely. And then on the valuation side, it's a little out of whack at the moment. It's trading at 30 times forward earnings versus tech's 26.5. And this is out of whack in the sense that normally it trades at a much lower forward earnings multiple. So once maybe those outlooks for improving earnings get into that consensus estimate, it will look even better on the valuation side. And with that in mind, though, it's still trading at a 22% discount to tech in terms of forward sales. It's trading at 3.7 times forward sales. And Micron also has a really great balance sheet, and 23 of the 27 brokerage recommendations Zacks has are sitting at strong buy. So overall, it's a bit more cyclical than the wider chip sector, but like with a lot of these chip companies at the moment, they see a longer term cycle for them to benefit from the expansion of AI, which is seemingly growing very, very rapidly. So Micron certainly worth considering at the moment. And now we're going to move on to Lululemon, which trades under the ticker LULU. And the company is set to report its Q4 2023 results on March 21st. So Lululemon shares are up about 60% in the last 12 months. This crushes Nike's 15% drop and its industry 17% climb, and roughly doubles the S&P 500. Overall, Lululemon has been a really impressive story in a space like it's in, which is kind of consumer discretionary goods. It sells high-end clothing, athleisure. It skyrocketed 900% in the last decade to blow away the benchmark, which up about 180%. Yet it might still be sitting at an attractive entry point for longer-term investors. So let's kind of dig into a little bit about Lululemon and then look at some of its levels and its outlook to see why you might want to consider buying it heading into that release or right after the release. So Lululemon, has changed the way kind of millions of people dress, as everyone from Nike and Target and kind of every other consumer company. You see so many of these online brands coming out with Lululemon style competition, that athleisure wear for men and women. It's turned now itself into a well-rounded sportswear and apparel company. Lululemon sells a range of clothing that you can wear to the gym, the office, date nights, golf course, kind of everywhere. They've kind of, as I said, changed the way a lot of people dress. Lululemon's so successful that now it's selling its own used clothes. You can buy and sell used clothes. This is something that's pretty popular on other really successful higher end clothing companies like Patagonia. So it just shows how brand loyal a lot of people are, that they're even willing to buy used clothes and buy and sell just for that brand and how it makes them feel and just how solid the clothing is. So Lululemon's consistent growth is really highly impressive, and it's powering through the recent consumer slowdown. So when you have a company like Dollar Tree saying they're about to close 1,000 stores, Lululemon's still expanding, they're trying to expand their store count. And that's driven by these higher income shoppers who are willing to pay, say, $130 for leggings or $90 for a shirt. So they're less susceptible to these wider trends in the consumer spending. So the company posted 30% revenue growth in fiscal 2022, 42% expansion in 2021, and before that it averaged 16% growth during that 5-year stretch before 2021. So Lululemon's executives also projected will double its net revenues between 2021 and 2026 as it expands its menswear business and other segments, and then tries to expand its global footprint as well. Looking ahead to what it's expected to report next week, or when it reports its Q4 results, we're calling for 18% revenue growth in fiscal 2023, all the way up to $9.6 billion, and then another 14% revenue growth next year, all the way up to about $10.9 billion, so nearly $11 billion. So consistent top line growth, even on top of these kind of several years of booming revenue growth. And then on the bottom line, we're calling for 24% adjusted earnings growth this year. So what it's about to report. And then next year, we're calling for another 15% growth on the bottom line. And overall, its earnings estimate revisions have been trending higher over the last year plus. And its most accurate estimates are coming in solidly above for next year, which is a good sign. So it's trending in the right direction going forward. That said, it does land as Zacks rank number 3 hold right now, though Wall Street remains really high on the stock overall with 17 of the 27 brokerage recommendations that we have coming in at strong buys. And then in terms of some of its technical metrics, it's back above its 50-day moving average after it found some buyers at its 21-day moving average, and it's now trading at around neutral RSI levels after a recent pullback off of its all-time highs at the end of 2023. And right now, if we look at a longer dated chart, it seems like buyers are stepping in right at its 21-week moving average, and as it sits at a 10-year time frame around neutral RSI levels as well. So it looks like buyers are stepping in, as I said, that 21-week moving average. And we could see maybe if it has a strong report, kind of climb back up towards its all-time highs. Lululemon's also trading at a 50% discount to its 10-year highs at 31.9 times forward 12-month earnings, which is actually right near its 10-year median, which is really impressive for a stock that's climbed 900% over the last decade. It also has a really sturdy balance sheet, great margins for a consumer discretionary company like it is, a retailer, and it's trading 11% below its average Zacks price target heading into that earnings release. So Lululemon, another name to consider heading into that report. Maybe you want to wait till after, alongside Micron. So both of these names should be on your radar heading into their earnings releases as possible longer term buy and hold candidates. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.